दिखा दो।
Hello everyone, welcome to today's session. Today's session is on INDS 36 impairment. I'll be talking about the basics of the impairment, how impairment analysis is done, how impairment assessment is done, what are the key factors that we need to take care while doing an impairment. We'll go through then some practical problems, practical solutions, and then in the last some bit of what can be done in the practical scenarios during the industry with related to the COVID-19. Okay, so let us move ahead. I'll start the presentation now. Okay, so This webinar is on India's 36 and its practical applications. Okay, what we are going to discuss is what is impairment, applicable to, when to check, what is different now, why with respect to the COVID-19, how to calculate, how to disclose, and some materials so that practical questions and everything we can take up. Okay, now moving ahead. So India's 36 primarily governs with the impairment of asset. Okay, now as per the India's 36, an asset is called impaired when a carrying value exceeds its recoverable amount. Now carrying value is what a carrying value? Carrying value means the amount which is in the books, the book value. Now when the recoverable amount exceeds the book value of an asset, that asset can be called as the impaired. For example, today I have a machinery which has a book value of rupees 100, and I know that the recoverable value of that machine. Now recoverable value are of two types. One, by using that machine, by putting that machine in the value. Number two, by selling out that machine. By selling out that machine, I can get an amount. That's also a recoverable amount. So either of the one, if either of the one is less than the carrying value, the book value of my machine, then I need to recognize the deduction, the less amount, the amount which is the smaller one, as my value of that machine, and the difference will be recognized as an impairment. Okay, so the decrease is can be due to various factors, can be an internal factors and can be external factors. We'll discuss while going through this presentation. Primarily, my para 8 contains the recognition for the impairment of asset. Moving ahead. Okay, now to which asset it is applicable. Now, if you see the India's 36, how it is structured, India's 36 has provided a negative list that to all these assets it is not applicable. Now, I'll take up you one by one with each class of asset and why it is excluded from India's 36. Okay, starting with first is the inventories. Now, inventories has been specifically excluded from the India's 36 para 2. That India's will not be applicable to the inventories. Impairment you are not required to calculate over the inventories. Why so? The reason behind the inventories is the inventory standard itself says that you need to recognize inventory at the cost or NRV, whichever is less. Now that NRV is nothing but the fair value less cost of disposal. If you see, the realizable value is nothing my fair value that I'll fetch in the market less cost of disposal. So I need to see what is my cost or NRV, and I need to record lower of both in the case of inventories. Hence, I'm already doing it. Hence, I'm already taking an account of the impairment in the case of inventories. Then why to again apply this standard? Already the standard of the inventories have taken care of. Asset arising from construction contracts. Now, in this case, standards construction contract standard specifically talks about a clause where you need to assess whether the contract is an onerous contract or not, whether there is a loss arising out of the contract. You need to assess at the end of each reporting period. In that case, that is already separately governed. Then why to include in this standard? That's why it has been excluded. Deferred tax assets and the deferred tax liabilities. Now, why these are being excluded? Deferred tax assets and the deferred tax liabilities are not required to be checked for the impairment. Reason because, number one, deferred tax assets are in temporary nature. As per the standard says that those are in the temporary nature, that they are going to be created now and they are going to be reversed in the future. Hence, now if we recognize the impairment and then in the future again we need to reverse that impairment, or we need to write off that asset at the end any which ways, then what is the need of recognizing the impairment as of now? Again, in the case of a deferred tax asset, we need to check whether there is a recoverability of the deferred tax asset, that whether the company will make profits in the future or not. So in that case, it is already covered by that. So the standard AS12 taxes, income taxes already covers that portion. Hence, it has been excluded from this standard specifically. Okay, now moving ahead, asset arising from employee benefits. Okay, Now, asset arising from employee benefits is a recognition of my that deferred tax recognition of my employee benefits liability, and in front of that there are the plans asset. Now, if you see the way we do, the way we recognize the plan asset is on the basis of the fair value. That is the actual valuation that we do at the end of each reporting period. Now, in that case, already we are recognizing the planned assets are at the fair value by through the way of actuarial valuation. Then what is again need to do for the impairment analysis? Impairment analysis is nothing but you check your carrying value and you check your fair value. Here we are recording the asset at the fair value. Then there will be no chances of impairment in case of my employee benefits. Financial assets. Again, there was a specific requirement in that standard which requires us to fair value through P&L, fair value through OCI. Now those standards talk about the specific requirement of doing the fair value of the financial assets. Then that's the reason that India's 36 has also specifically excluded financial assets. Now biological assets are something different. The recognition, the measurement, and everything is dealt with a separate standard, altogether separate standard, and hence that has been excluded from this list. Deferred acquisition cost and intangible asset. Okay, now these are certain things that you have already incurred. These are certain things that you have already incurred. You are charging off on a recurring basis. Hence, an expense already incurred is not, you cannot calculate the recoverable amount or value in use. Hence, these are being excluded from my Ind AS 36. Non-current asset held for sale. Now, non-current asset held for sale are nothing but they are recognized on the basis of their net realizable value. Now, whatever I am going to receive, I have recognized that in my books of account. Another thing is when I stopped using the asset, there can be nil value in use because I'm not going to use the asset in future. There will be a nil value. So I won't be generating any cash flow by use of that asset. So again, the standard says that fair value less cost of disposal or value in use, both higher of both, we need to consider in front of the carrying value. But here in this case, in non-current asset held for sale, there won't be any my value in use. There will be my NRV at which I am going to sell that asset. The price I am going to fetch from the sale of asset, and I have already recognized in my books. And hence again, this non-current asset held for sale are excluded specifically. There is no requirement to calculate again the impairment. So these all categories are excluded from Ind AS 36. Other than these, anything which is there can be considered for the impairment analysis. Going ahead, when to check for impairment? Now the standard specifically says that the entity shall assess at the end of each reporting period whether there is any indication that the asset may be impaired. Now we need to check for the indication. We are not supposed to perform the impairment analysis at the end of each reporting period. There is an exception for that. I'll come to that later. But for normal class of assets, we need to check for the indications. Indications can be external, indications can be internal. We'll come to that. If such indications exist, then and then only we need to calculate the impairment, and then we need to perform the impairment assessment. And after performing the assessment, if there is an impairment loss that the carrying value is the carrying value is more than the recoverable amount, then the differential should be recorded as the impairment loss. Now, as I said, there is an exception to this, that for not each and every class of asset we need to check for the indication. So the exceptions are intangible asset with an indefinite useful life. Now these are the assets that for which we are not supposed to check the indication, rather we are supposed to perform the impairment analysis directly without any indications present or not. Second is intangible asset not yet available for use. In that case, again, we are not supposed to check indication. We directly need to perform the impairment analysis. Third is the goodwill acquired in the business combination. In that case also, we are not supposed to check for the indication. At the end of each reporting period annually, we need to check for the impairment analysis. Now, impairment analysis for these kind of asset can be at the end of each reporting period or can be in the middle of the reporting period. But the company, the management needs to follow the consistency. So, for example, today in the for example, in the year 2019, I calculated the impairment analysis at the end of the September quarter. The next year also I need to calculate at the end of the September quarter. Moving ahead. Okay, as I said, there are two types of indications. There's two type of source for the indications. Now these are the external sources and the internal sources. Now what are these external sources and the internal sources? External sources can be like, market conditions, significant economic changes, changes in the legal requirement, can be, change in the market, change in the economic scenario of the country. There is a war, there is a pandemic, there's lockdown, there's a change in the law which makes, production very difficult. There's a there can be a various scenarios, external factors because of which, I can assess that there can be impairment. I can, think about the impairment can be there. Let's suppose there's a market conditions, there's a huge recession going on, there's a huge depression going on like 2008. If the production has hampered, in that case I can consider, okay, there can be an impairment on my assets. Significant economic changes. So for example, currently the lockdown which is going on will fall under the significant economic changes. Legal changes. Suddenly a production of certain items has been banned or has been, under the regulatory purview, or there has been change for the licenses. For example, carbon emissions. So you need to obtain the carbon license before producing the chemicals or the products which have a huge carbon emission, and you are not able to produce. There is a huge cost involved now. So because of that also it can happen. Change in market rates. So for example, we used to import the raw material for production. Now because of change in the forex rates, the raw material is rarely available. It's very costly also. So in that case, it can happen that, it hampers your production, it hampers your machinery. So in that case, you need to check for the impairment analysis of your asset. Again, now internal sources of information. Internal sources of the information for the impairment analysis can be like, obsolescence of my inventory, of my machinery. Sorry, not inventory. Inventory is excluded. Obsolescence of my machinery. Then there is a damage due to fire or something on my machineries. There's the breakdown of the machinery. Okay. Now the another can be scenario is then, significant labor strike within the companies. Again, another scenario can be a negative cash flow. The company is incurring continuous cash losses from the years. Like for example, since last 2 years, the company has incurred my cash losses. There can be an adverse financial ratios. There's a high negative high my quick ratio, negative my current ratios. I don't have a debt service coverage ratio, good service debt service coverage ratio. So these can be an example where I can see, the financial ratios are adverse. There is a loss, cash loss, continuous cash loss, and in this case I can, see I can there is an indication that there can be a chances of impairment. Now impairment can be of a goodwill, impairment can be of assets that we need to analyze, that we need to check. Okay, moving ahead. So like for example, if I add one example that, okay, actual net cash flows from operating activities is negative since years. So in that case, yeah, and the significant decrease in the budgeted values compared to the. Okay, now what is different as per the COVID-19? Why this also important in the COVID scenario? Okay, due to COVID-19, there can be a temporary ceasing of operations, an immediate decline in the demand, lower prices and profitability. There can be these type of scenario. For example, let's say a travel industry, they're totally shut today. They're not working at all. Airlines industry, they are not working at all. Their aircraft are lying in the airport. So because of these scenario, my asset may be, lying somewhere. Now, hence I can recognize, I can see there can be, impairment on my asset, and hence I need to see. So for example, let's say aircraft industries. So aircrafts are lying in the hangar. I presume that for the next 6 months, The airline industry is going to suffer a huge decrease in the demand, huge decrease in the passenger flying, and hence there will be a less amount of revenue you can generate from the airline aircraft. So as I said, how impairment is calculated? I need to check a recoverable amount. Recoverable amount can be my amount which I can derive by using that asset either. So if I use that aircraft, I know very less passengers are going to turn up and there will be a very less amount. Number two, by selling that aircraft. As of today, we know that the airline industry is suffering huge adverse effect due to lockdown. If I go to the market, if I try to sell my aircraft, who will buy? Because everyone is suffering. No one will going to, no one is interested in investing in airline industry. Hence, no one will buy the aircraft. In that scenario, the net selling price, the fair value of that aircraft will also be very less compared to the value that of that aircraft in my books of account. Hence, the difference of the both, that the value in the recoverable amount, either the value in use or the fair value less cost of disposal in compared to my carrying amount, is required to be recorded in my books as a impairment loss. So airlines industry, travel industry, tourism, then the normal bus operators. So these are the people whose assets are lying idle as of now. So these are the factors that the management may consider as an economic indicators for their impairment testing, and these may present as an impairment indication. If you see the para 12b of the India's 36, it specifically talks about these kind of scenarios, which says that significant changes with an adverse effect on the entity have taken place during the period. This is the significant changes, and this has resulted in the adverse effect, or will take in the near future. Again, in the near future also, I predict that the demand is going to be low, or there is a change in the technology market or economic or legal environment in which an entity operates. Okay, so this is a so we need to take care the impairment analysis in the COVID with special attention. Now moving ahead. Okay, coming to the impairment of asset. As I said, impairment of asset is measured. The impairment loss is a measured difference between the carrying amount of the asset and higher of fair value less cost of disposal and value in use. Okay, let me explain you each term in detail. What is fair value less cost of disposal? Now, fair value is nothing but the value calculated as per the India's 113. But in actual, practically, the fair value is nothing that the amount at which I am ready to sell the asset and someone is ready to buy. So it's the arm's length price for the sale of asset today. If I'm going to sell today, the price which I'll fetch in the market. For example, I have a machinery which has a book value of 100. Now, if I go in the market and sell that machinery, the second-hand machinery, I may get a 60 rupees. So fair value will be 60 rupees. Now, cost of disposal. Cost of disposal, for example, I may incur many expenses, stamp duty expenses, XYZ expenses. So I need to deduct that expenses to derive my amount which I'll actually receive, the cash inflow by selling that asset. So today, if I say that amount I will receive by selling that asset will be, let's say 80 rupees that I will fetch by selling the machine, plus the expense I will incur to sell that machine, maybe transportation cost. So in that case, the net, let's say the cost is 10 rupees. The 70 rupees is my cash inflow, will be the fair value less cost of disposal, FELC. The another is value in use. Value in use is nothing but the amount I am going to earn during the period of machinery by utilizing that machinery. So for example, today I have a car. I have a business of taxi driving. Okay. Now, if I give that car to my driver and he drives in a daily basis, and in a yearly time, he earns rupees 100. For example, he earns rupees 100. So the value in use of that car will be 100 rupees. So over the period of, let's say, car has a useful life of 5 years. Now, over the period of 5 years, if the driver can earn 500 rupees from that by driving that car, by taking the passengers to their destination, so that 500 rupees will be the value in use. Now, higher of both we need to consider. So for example, why higher of both? There is a logic behind it. So for example, if today I'll sell the car, I am getting 80 rupees, less cost minus 70 rupees. And if I use that car, I'm getting rupees 500. Then in a prudent man, as a prudent management also, prudent company will never sell the car. Rather, they will use that car and they will derive the benefit of 500. Unless and until there is an emergency situation and there is an exceptional requirement. Hence, in that scenario, we need to consider those exceptional requirements. But usually, if I'm getting 500 rupees by using that car, I'll make a rational decision. I'll use that machinery for that period and I'll earn 500 rather than selling it now and getting 70 rupees. Let's say the carrying amount. I bought that machinery, that car at rupees use, let's say 700. Today, the carrying value in my books is 700 after the depreciation. And the value in use I'm deriving at the 500. So I know that by using that asset also, I won't be able to get any benefit beyond 500. And hence the excess of 200 is my loss I know today. In that case, I need to recognize that loss today. That is the impairment loss. Okay. Now, for example, let's say my value in use, if I derive by that car, my carrying value is 700. My value in use, let's say I derive 900 by using that car. Do I need to calculate fair value less cost of disposal? The answer is no. Why? Once you calculate any of the amount, like either fair value less cost of disposal or value in use, and that amount turns to be higher amount than my carrying amount of the asset. So for example, today I find out that my carrying value is rupees 700 and fair value, let's say suddenly there's a jump in the model of the price. By second-hand price, I can, by selling the second-hand car, I can fetch a price, let's say 800. In that scenario, already the fair value is 800, which is above carrying value. So let's say in that scenario, if the value in use also is less, let's assume that value in use comes to a lesser amount than the carrying value. Still, the higher of the following, the fair value less cost of disposal and the value in use will be taken as a recoverable amount. And the recoverable amounts less carrying amount will be my impairment loss. In this case, if any of the amount is a higher, my recoverable amount will be higher and there will be no impairment loss. So if I calculate any of the amount and that amount turns up to be the higher than the carrying value, then I need to stop my procedure of the impairment analysis at that point in time only, because I know there won't be any impairment loss on this asset. Moving ahead. Okay, as I said, fair value. Now, fair value is governed by India's 113 and India's 36 both. There are separate requirements. So, para 9 specifically governs the what is the fair value. In India's 36, para 25 to 27 provides some additional description about the fair value. Okay. Let us go through these definitions and the additional descriptions. As per the 113, fair value is nothing but the price that would be received to sell an asset or paid to transfer a liability. Okay, so today, for example, if I have a car, if I sell that car, the price I will be receiving by selling that car would be my fair value. Now, again the question comes that the transaction should be in orderly fashion. Now, what is an orderly fashion? Orderly fashion that the transaction should be between the non-related parties at the arm's length price. And that's an orderly fashion. Then the requirement is that it should be between the market participants. Okay, market participant is something, both are, so one is a buyer, one is a seller. So I am the buyer. I will use that asset. I'm just not buying for the purpose of some arrangement like that guy wants to sell and I want to buy. That's it. So I'm the market participant. I will buy and I will use that asset. There's an intention to use that asset at my end, or either resell it. So my business is reselling. So in both of the cases, it will be the use of asset. At the measurement date, so value of the asset by selling it. So for example, if I'm calculating the impairment analysis as on 31st March 2020, then I need to check fair value as on 31st March 2020, and I need to check the price that I will receive by selling that asset on that date. I cannot say that, okay, the price 3 months ago was higher, now it has been decreased due to COVID, so I'll take the higher price. No, I need to take the price of that date only when I'm doing the, for which I'm doing the impairment analysis. Okay. Now again, the best evidence of an asset's fair value less cost to sell is a price binding of a sale agreement. So for example, let's say I have a sale agreement, binding sale agreement that after I will be selling that asset to that party, or agreement is done, only the transfer is pending. So in that case, that will be the best proof, that will be the best source of my fair value. These are the additional requirements which are given in the NDS 36. If there is no binding sale agreement or active market for that asset, fair value less cost to sell is based on the best information available to reflect that amount that an entity can obtain. So in that case, what will happen is the fair value will be, will be based on my the estimation or the information I may have in my hand. Let's say I knew that on 31st March 2020, the fair value of an asset was 100. And let's say I'm doing an impairment analysis at the June quarter, 30th June 2020. So from that period to this period, the change in the market scenarios, I need to, add those changes in the market scenario to the price which was available at the March end. And then I need to derive a price based on my information available for the June end, and I need to take the June end price for the impairment analysis if I'm doing the impairment analysis at the June end. Moving ahead, cost of disposal. Cost of disposal, like as I said, there can be a various cost of disposal. It can be a legal cost. For example, if I'm transferring the building, there can be a stamp duty charges. There can be a specific charges if the building is situated in a SCZ. I need to do additional formalities. So there can be different taxes also for selling an asset. I may need to pay GST. There can be XYZ amount. There can be a cost of removing the asset. So for example, let's see telecom industry. Today they have the towers installed on the places. Now tomorrow, if I want to sell that tower, I may require to sell in a decommissioned form, in a removed form. So the installation cost which I incurred, so the installation which I did of the tower, I need to decommission it. I may incur at the time of sale that I need to additional cost of decommissioning. Direct incremental cost to bring an asset into the condition for its sale. So for example, today I have a car, I want to sell. I cannot just go out of my office and sell the car. I need to have a marketplace. I need to market the car. So I may go on the OLX, I may register my car, or I may go to somewhere else to the third party dealer. He may charge a commission to sell the car, or there can be XYZ to make my product marketable, rendable, market rendered. In that case, the amount incurred as an additional, direct incremental cost to sell that asset will also be considered and will be deducted from my fair value. However, termination benefits, employee benefits, termination benefits, or cost recognized with the reorganizing and restructuring of an asset will not be counted in cost of disposal. Moving ahead, value in use. Okay, now value in use is nothing but, as I said, the amount I'm going to derive by using that asset. Now, what is using that asset? How can I determine that how much amount I'm going to derive by using that asset? Best way is the future cash flows. Okay, so let's say, as I said, a car example. So if today I'm using a car, I have given a car for the taxi purposes. Now, to determine what amount I will be deriving by use of this car is the best way to estimate the future cash flows that I'm going to earn. Now, future cash flows can be based on various things, like for example, prepared by the management, past trends that past 5 years I have earned yearly this much cash flows. So by this way, I can predict cash flows during the period of the life of the value of the car, and those cash flows, then I need to discount based on the time value of money. So for example, after 5 years, I'm going to receive 100 rupees from use of that car. Today, that 100 rupees will have a different value based on time value of money, and hence I need to discount that thing. So I need to discount all of the cash flows which I will be receiving to the present value, and that present value will reflect the value in use. There are other things also that I need to consider while determining the value in use. That is the expectations about the possible variation in the amount or timing of those future cash flows. So for example, let's say based on the past trend, I know that yearly I get 100 rupees from the use of that car, but there is a 90% probability or 80% probability that I may get 100, or there is a 20% probability that I may get a lesser amount, let's say 50 rupees. In that case, I need to consider those expectations. I need to consider those probability analysis, and accordingly I need to derive my future cash flow. The price for bearing the uncertainty inherent in that asset. So for example, if there is some risk uncertainty in that asset, then in that case, I need to recognize that also. Other factors such as illiquidity that the market participant would reflect. So for example, let's say aircraft. I know that aircraft are going, are very costly. So I know there can be a huge issue while buying and selling an aircraft, or also while using the aircraft because of the market condition, there can be issues. So I need to consider all those requirements. Now, for example, if I calculate value in use, then I need to discount it. We know that. What if my asset is lying in a foreign location where the value in use will be in foreign currency? For that, I have prepared one example, and we'll go through with an example to understand how I need to recognize that value in use. Just a moment, I'll share that example. Okay. So this is a question. During the year, management, considering the COVID-19 momentum basis, they decide to test its asset 1 for the impairment. Under the seed testing, the management identified the value in use of the asset operating in the Europe region and its fair value less cost of disposal, which is given below. So my discounting rate in the India is 10%. Let's say hypothetical example, risk-free rate of return. Discounting rate in Europe is 2. Differential in the rate of interest it can be. Now calculate the value in use with the cash flow 60, 80, 100, 110 and 90 in year 1, 2, 3, 4, 5 respectively. Now these amounts are in euros. I know that my asset is lying in Europe, and there is a COVID impact in the Europe, so I will take that indication. I will test for the impairment. Now, as I said, value in use is nothing but the amount I will receive by using that asset through the useful life of that asset. Let's say the asset useful life is 5 years. Now I am getting 60, 80, 100, 110 and 90 euros each year respectively, 1, 2, 3, 4, 5. And the discounting rate in India and the Europe are different. What I can do is I need to first discount the cash flows based on the rate prevailing in the Europe. So I'll do the discounting of cash flows with the European rate. Then basis of the spot rate available as on 31st March 2020, I need to convert that value in INR. So for example, let's say in this current example, I will convert and I will derive a discounted cash flow of 413.09 euros as in my value in use, but that is in euros. Let's say, for example, hypothetical example, the spot rate is on 31st March 2020 for euro to INR is 95. In that case, the value in use in INR will be 39,000. Now, most of the people, may follow a different approach, like first converting the cash flows into the INR and then applying the discount rate of the Indian discount rate. That approach is wrong. That approach is not as viable. Why? Reason: there is a risk attached to an asset. There is a discounting rate attached to an asset. So if we'll change the discounting rate attached to that asset, the answer will not be the same answer. Today I'm discounting at the rate of 2% because the asset is lying in the 2% risk environment, not into the 10% risk environment. So if I discount at the 10%, the amount will be the different. The value in use will be the different, and that will be the wrong value. Hence, first I need to convert the present value. I need to convert it to the present value by using the rate in which the asset is lying. So asset is lying in the Europe, so I need to use the European rate. Then I need to convert that euro into the INR by using the spot rate. So by this way, I need to derive the value in use in INR from foreign currency. Okay, let's back move to the PPT. Okay. As I said, spot rate should be used to translate my value in use from foreign currency to the reporting currency. Moving ahead. Okay. Components of my future cash flow. As I said, I need to calculate how much amount I will be earning. I need to see not only earnings, but the future cash outflows also incurred to generate that cash flow. So for example, let's say taxi driver example. Now we know that the amount I'll be earning is the fare that the passengers will be paying. However, there will be an outflow also of the diesel, of the maintenance, of XYZ amount, let's say tolls that I may need to incur, okay, to generate that cash inflow. So that cash outflow is also I need to recognize. Further, I also need to recognize net cash flow by selling this asset. So at the end of 5 years, when I sell that asset and the end of its useful life, so whatever amount I will receive, that I also need to consider in my cash flows. So in total, I need to consider cash inflow, the income which I will derive, cash outflow directly attributable to that cash inflow. Third, the net cash flow, while I will the amount I will receive at the time of disposal of the asset. Now, what are the things I'm not supposed to calculate and include in my cash flows? Is the amount from the financing activity. Let's say I have taken a loan to purchase the asset. Should I require, am I required to consider that interest? The answer is no. Amount from the financing activity, interest on the loan is not required to be considered. Income tax receipts or payment. So for example, there is some subsidy income tax deduction in the case of additional depreciation or XYZ. So those income tax receipts and payments I'm also not required to consider. Now, another thing is future cash flows shall be estimated for the asset in its current economic condition. So for example, I say I have a car, 2 years used car. I need to consider that future cash flow from the current economic condition of that car. So for example, if I say after 5 years, I'll get it car renewed and I'll go again for the 5 years. That is the future thing, future phenomena. I'm not supposed to consider that future phenomena. I need to consider the current economic scenario. I may say tomorrow I may upgrade my car and I will get an additional fare. No, that is not the correct way. I need to consider the current economic scenario, current conditions of the car, and I need to derive the economic benefit which I'm going to earn from that car. Again, one more thing, a future restructuring to which entity is yet not committed or improving or advancing should not be considered. Okay, now what it means, like I'll case a classic example of Vodafone Idea. Till the time they both not have signed the agreement, Vodafone was not supposed to consider the cash inflows or the additional revenue they are going to earn when there will be a synergy between the Vodafone and the Idea from the telecom operations. In that case, if that commitment is not yet done, then the Vodafone cannot consider just by merely the talks which are going on. Commitment means signing of the submission of the draft agreement of the sale and purchase of the asset or the merger or whatever scenario is there, and it should be approved one. If the future restructuring is approved. We know that the Vodafone Idea deal is approved by MCA, by all the relevant authorities, and it is going to happen after, let's say, 1 year. At the end of 31st March 2021, all the effects will be gone at that time. Then, while doing the impairment analysis as on 31st March 2020, I need to consider the effect of that future restructuring, the synergies and everything, because it is committed. Okay, moving ahead. Future cash flows. As I said, in measuring the value in use, an entity shall base the future projections with a reasonable supporting assumptions. I cannot say, for example, right now lockdown is going on. I cannot say the amount I earned in the last year will be the same amount I will be earning in the same current year. So it should be based on the projections, and reasonable supporting assumptions should be there. Okay. Now, if for example, if a asset has a useful life of 10 years, let's say my car, so a maximum allowed period to do the projections and the forecast is the 5 years as per the standard. So standard says that we can, predict, forecast the cash flows for the 5 years. Then post that, the prediction and the forecast can be, cannot be accurate. May be subject to, some distortions which may come after 5 years, and hence the standards ask that after 5 years we need to account the future cash flows based on a growth rate. Now the growth rate should be either declining or steady growth rate. So for example, at the end of fifth year, I said I will earn 100 rupees as in cash flow. Now let's say I say a growth rate. Growth rate is, let's say, 10% for the next year, sixth year. So 10% of 100 will be 110. So if I assume the growth rate for the seventh year is 11%, that is not allowed unless and until I have a detailed explanation, detailed assumptions to support that increase. Otherwise, either it should be the 10% each and every year, steady growth rate, or declining that 10, 9, 8, like this. It cannot be increasing growth rate like 10, 11, 12. No. Growth rate which I need to use for the extrapolating beyond 5 years should be declining or steady. Moving ahead, impairment loss. As we saw, value in use, my fair value less cost of disposal, and the carrying amount. If I move back to my original upper slide, which was pertaining to this impairment of asset. Impairment of asset is nothing but the carrying amount of the asset less higher of fair value less cost of disposal and value in use. So this amount, the difference between both will be my impairment loss that I need to recognize. And how I need to recognize, we'll discuss now. An impairment loss shall be recognized immediately in the profit and loss account in the period in which such assessment is done. So for example, I am doing an assessment in the financial year 1920 at the end of period 31st March 2020. Then in that year only I need to recognize the impairment loss. I cannot delay recognizing the impairment loss to the next year. Any impairment loss of a revalued asset shall be treated as a revaluation decrease. For example, I had a building which I revalued in the past. Let's say 100 rupees building was revalued at the 200. Now I have a revaluation reserve of 100. Now if I recognize an impairment loss of 50, then that 50 rupees impairment loss should be first adjusted in the front of the revaluation. That rupees 100 will be adjusted by rupees 50, and the net revaluation reserve and gain will be only 50. After recognition of the impairment loss, the depreciation charge for the asset shall be adjusted for the future period. So for example, my carrying value earlier was 80 rupees. Now by applying the 20% impairment loss, the book value, the carrying value has been decreased to the 60. Hence, I need to consider the depreciation accordingly over the 60 rupees and the useful life if there is a decrease in the useful life. Okay. Now this was the till now this was the impairment analysis based on the asset. Okay. We'll take up some examples also for these sort of scenarios. Let me share. Okay. Okay. Now some practical problems which may come with the impairment of the asset. Okay. During the year, management considered impairment testing over its building, which was priced at rupees 40 lakhs in the books, with the estimated useful life of 30 years. On balance sheet date, the carrying value of the said asset was 25 lakhs. Upon inquiring in the market, the company identified the fair value of the asset at the 20 lakhs. Now, if I go and if I sell that asset, I'll fetch only 20 lakhs because there is a decrease, there is a depression in the market, there's a recession in the market in the property price, and hence I will receive a less amount. So there was a decrease in the value of building due to external factors. Now management is planning to use that building, management is planning to use that building for its headquarters where the employee sits, and management in that case, it's very difficult or it's not possible to determine the value in use. So should I recognize an impairment loss based on the fair value which I'm going to sell the asset? So fair value is 20 lakhs and the carrying value in the books is 25 lakhs. Also, management has an intention that management will continue using this building and will not buy any other building for the HQ operations and will not sell these buildings. In that case, I am not supposed to recognize the impairment loss. Reason being, as I said, if we go back, if we remember the fair value requires the market participants. Here, I am not supposed to sell. Here, I don't have an intention to sell. Hence, the fair value of 20 lakhs will not be considered as the appropriate fair value because I don't have an intention to sell. There should be an intention to sell. There should be an intention to buy. If both the intentions are present, then only there will be appropriate fair value. In that case, 20 lakhs will not be considered as the appropriate fair value. There is no intention to sell and hence there will be no recognition of the impairment loss. If in the current example, if the management had an opinion that it is going to sell the building, in that case we may consider the 20 lakhs and we may move ahead with the impairment loss of 5 lakhs. Okay, this we consider the foreign exchange one. Okay, third, let's suppose a company operates a mine in a country where the legislations require that the owner must restore the site on the completion of mining operations. At times there are that we need to restore the land, and the cost of restoration includes the replacement of the overburden that we need to fill up that mine again, which must be removed before the mining operations with operations commencement. Okay. A provision for the cost to replace the overburden was recognized as soon as the overburden was removed. The amount provided as recognized as the cost of mine and is being depreciated over the mine's useful life. Now, the carrying amount of the provision of the restoration cost is rupees 500, which is equal to the present value of the restoration cost. This is a hypothetical example. Now, as I said, the fair value less cost of disposal is required to be considered. Now, restoration cost is the cost of disposal that I need to consider. So, entity is testing for mine for impairment. The cash generating unit for the mine as a whole, or either as an asset as a whole. The entity has received various offers to buy the mine at the price of rupees 800. Okay, so it will become our fair value. The price reflects that the buyer will assume that the obligation to restore the cost of burden. Okay, fair value includes the cost of burden. So I am not supposed to less this cost again. The disposal cost for the mine are negligible. So again, there is no disposal cost. So directly 800 will become my fair value. The value in use of the mine is approximately 1200, excluding the restoration cost. As I said, the fair value has a three component. One, the cash inflow, the revenue, the cash outflow, which I'm going to incur to to generate that inflow. Third is the disposable amount I'm going to receive. So if I'll sell that mine, if I close that mine at the disposable, I need to incur that expense. So there is a negative cash flow at the disposal that I need to consider. How will I consider? We'll look into that. Excluding the restoration cost. The carrying amount of mine is 1000 rupees. So in this case, what will be the impairment, if any? So my carrying amount is 1000, my value in use is 1200, my fair value is 800, and there is a restoration cost of 500. So in this case, the value in use for the mine will be rupees 700. How? The value in use, this less my restoration cost of 500 will be my value in use for the mine, that is rupees 700. My fair value is rupees 800. So fair value or value in use, 800 or 700, which is higher, I need to concede, I need to take as a recoverable amount. So 800 will be my recoverable amount. Now the question comes with the carrying amount. Is carrying amount going to be my 1000? The answer is no. Carrying amount is not going to be 1000. At the end of the asset, selling of the asset, there is a liability standing in front of the asset. When I'll sell that asset, I need to settle down that liability. So not only the book value of the asset, but the book value of the liability also I need to consider before selling that asset. Hence, the carrying amount of that asset today will be the carrying amount less restoration cost. That will be 500 rupees. So carrying amount is 500. As I said, fair value 800 and the value is used in 700. So 800 will be my recoverable amount. So recoverable amount is higher than my carrying amount. So there is no need for impairment. In this scenario, we need to consider if there is a liability standing in front of our asset, we need to consider that liability in front of that asset's carrying amount also. Okay. Now let's move to the again PPT. We'll take up further with some of the more topics in the impairment. Cash generating unit. Why this is into the picture? So at times, for example, let's say one example of cloth processing first. Let's say I have a raw material as a raw cloth, which I go for my processing, color processing in machine one. Then I get a color cloth as an intermediary product. Then again it goes for the stitching and cutting. Then at the end, after the stitching and cutting, I get the final garment which I sell in the market. Now in this whole process, can I derive the value in use of the machinery one? Can I derive the fair value of the machinery when in standalone basis? I may able to derive the fair value less cost of disposal, but I might not be able to derive the value in use, because this as a single machinery doesn't generate any revenue. This whole process, this whole factory generates the whole revenue, which includes two machineries. So hence the machinery one individual at individual level may not be able to demonstrate the value in use. It may be able to demonstrate the fair value less cost of disposal, but that will be again not appropriate. Why? Because the fair value by selling an asset may be lesser than if I combine this asset, this machinery with other machinery and use it. Hence, as a rational, as a prudent company, what I will do is I'll take this machinery, I'll take another machinery, I'll combine both of them and I'll generate higher revenue rather than selling individual both of the machineries. Hence, I'm not supposed to consider that fair value also. In this case, I may not be able to calculate the impairment for this individual machinery. Hence, I need to consider the impairment for this whole process, and this whole process is known as the cash generating unit. This whole machinery 1, machinery 2 together will be known as a cash generating unit. So cash generating unit is the smallest unit identifiable group of assets that generate cash inflow that are largely independent of the cash inflows from the other assets or group of assets. So for example, I have another assembly line also, which can, which is capable of generating cash flows separately. In that case, this assembly line of two machineries and the other assembly line will be two separate cash generating units. Whatsoever we have learned till now for the impairment of the asset will in the same way will be applicable to the cash generating units. So in the case of cash generating also, we are required to calculate the fair value less cost of disposal. We are required to calculate the carrying amount. We are required to calculate the value in use and recoverable amount by comparing the higher of fair value less cost of disposal and value in use. In the same way, we will be calculating the loss of impairment by comparing the carrying value and the recoverable value of that cash generating units. And the value of that cash generating units will be not but the carrying value of that cash generating unit will be based on by the carrying value of those sum of carrying value of those assets. Okay, now while, as I said, that we need to consider those machineries, am I supposed to consider the liabilities in front of those machineries? Let's say loans, let's say some other liabilities that I have. So if those liabilities are necessary, okay, for those disposal of the cash generating units, like we saw the restoration cost, liability for the restoration cost, then and then only I need to consider. Otherwise, I'm not required to consider any other liability in cash generating unit. Let's say it's a payable for that whole cloth process, payable for the raw garment which I purchased. I'm not required to consider that as a in cash generating units. So liability will not be considered unless and until there is a specific liability upon the asset which is required to be settled before disposing that asset. Going ahead, goodwill. As I said, goodwill and infinite these goodwill acquired at the business and the starting we, as I said, and the intangible asset at the having an indefinite useful life are required to be tested at the end of each reporting period or each year at the equal interval. Like for example, if I calculated this year in the month of March, same way I need to calculate in the month of March only in next year. So at the equal distance. Now, how am I supposed to calculate? So the goodwill impairment, goodwill, if you know, can you derive the value in use of goodwill? No. Can you derive the fair value less cost of use goodwill? No. We cannot derive both of the amount. So goodwill will not have a recoverable amount. So then how to calculate the impairment loss over the goodwill? How to calculate the impairment recoverable amount of the goodwill so that we can, compare with the carrying amount. In this case, each unit or the group of units, like we say, each unit means cash generating unit or the group of cash generating units shall be allocated the goodwill. Now, goodwill should be allocated to represent the lowest level within the unit entity at which the goodwill is monitored. So, for example, let's say assembling line, that cloth manufacturing line and the assembly line. They are two separate lines. So, goodwill will be allocated on a specific basis, on a specific criteria. Let's say proportionately. Let's say based on the acquired business to assembly line and to the cloth manufacturing line. And on the basis of that, once it will be allocated to those cash generating units. Those cash generating units then are tested for the impairment. And when I will calculate the carrying amount of that cash generating unit, I need to consider the amount of goodwill in the carrying amount. However, recoverable amount or that is fair value less cost of disposal or value in use will be based on the amount I am going to earn by selling those cash generating units. I'll take up an example for that. Let's take an example. Okay. Let's say this is an example where I have a CGU1 which consists of machinery 1, 2, 3, furniture, corporate asset and goodwill. Now let's say the recoverable value in use and the fair value less cost of disposal of this CGU is 300 and 190. The total carrying value is 390. Then I can see the recoverable amount from the higher of both will be 300 and the total of carrying value is 390. So recoverable amount is less than my carrying value. I need to recognize the impairment loss in this scenario, and the 90 rupees impairment loss will be recognized to this TGO. Now the question comes, how am I going to record this 90 rupees impairment loss over these assets? There's a machinery 1, there's a machinery 2. May I record all to the machinery 1? Should I record to 40, 30 and 20 furniture, corporate asset and goodwill, and I leave the machinery 1 to 3 like this only? How am I supposed to record? So the standard says that when there is a impairment loss over cash generating unit and there is a goodwill in that cash generating unit, then in that case the loss first should be fully set with the goodwill. So if we see the calculation, as I said, the impairment loss is 90. So first I need to recognize the impairment loss full allocation in front of the goodwill. Then the rest of the impairment loss, that is 70 rupees, after recognizing my 90 rupees, is required to be allocated in front of the each asset in the proportion of their carrying value. The proportion of their carrying value, for example, let's say machine 1. Machine 1 has a 100 rupees carrying value. Now what will be the proportion of the carrying value is total carrying value will be this much: 100, 110, 90, 40, 30. So 390 minus 20, this will be the total 370 will be the total carrying value of this rest of the cash generating unit. And carrying value of machinery 1 is 100. So 100 by 370 will be the proportion in which I need to recognize the impairment loss of rupees 70. So 70 into 100 by 370 will be 18 rupees, rounded off to 19, will be the impairment loss based on its carrying value recognized in the front of machinery 1. In the same way, 20, 17, 18, 6 and 20 will be recognized in front of each asset as an impairment loss. These are the rounded off figures. Hence, first I need to allocate in the front of the goodwill full amount, then I need to recognize in front of the each asset proportionately to the carrying value in compared to the total carrying value of the rest of the cash generating unit. This is how I'm supposed to recognize the impairment loss in case of CGUs. First fully in front of goodwill, then in the front of assets. Coming back to the PPT, we saw that how to recognize in front of the goodwill. So impairment loss shall be recognized for cash generating unit, the smallest group of cash generating unit to which the goodwill or corporate asset has been allocated. The impairment loss shall be allocated to reduce the carrying amount those assets in the following order. The following order is: first, reduce the carrying amount of any goodwill allocated to the cash generating unit. So we reduce the 20 rupees. Then go for the other assets in a proportionate and a pro rata basis of their carrying amount. Again, so impairment loss should not exceed the fair value less cost of disposal or value in use or the amount of 0. This should be the maximum carrying amount of my asset, and the difference will be my impairment loss. Okay, guys, this was from my side. I would like to hear any questions from your side. Any questions, guys, from your side? Okay, yeah. Will there be any difference in reporting impairment loss under normal circumstances and under COVID circumstances? COVID circumstances will provide you an indication that there will be a difference. There will be an impairment loss. There can be an impairment loss. So because of COVID circumstances, we are supposed to check for the impairment. There is an indication, but the calculation of the impairment will not differ. That the formula will be the same. That the higher of the fair value less cost of disposal or the value in use will be my recoverable amount, and the difference of the carrying amount and the recoverable amount, if the carrying amount is if the carrying amount is higher, then the difference will be recognized as my impairment loss. Now, when I'm calculating the value in use, the COVID-19 may affect my value in use, because value in use is nothing but the estimation of the future cash flows. And because of this lockdown, I need to consider that there will be a less future cash flows, there will be less sales, there will be a less demand, and hence my value in use will be less. Another is, so I think I hope I have replied that question. Another question is, since value in use is entity specific, whereas fair value is market specific, then how value in use considered for fair value determination? Okay, first of all, value in use, yeah, I totally agree, is a entity specific. However, there are other elements also, that market conditions, my future cash flow estimations, there are other conditions which will affect my value in use. Fair value is market specific. Agree that I will sell the asset and whatever amount I will receive will be my fair value. Then how fair value in use is considered for market value in use for considering fair value. So fair value determination is altogether a separate basis, will be on a separate standalone basis. The amount at which I am going to sell the asset. Value in use is altogether a separate standalone basis, that the estimation of the amount I am going to receive in the future by using that asset. Both are different in that case. Okay. Another question is, in this case, there are no CGUs, then how good will be allocated? It is then between the asset. So at the end, there will be one CGU, whole of your business. It is not possible that you won't have any CGU. I mean, do not have a multiple CGUs, but I will have a one CGU as a business as a whole, which will earn a revenue. So that CGU will be allocated to your business. There is no bottoms up approach in NDS as what in AS. No. In this case here in the NDS, first we need to write off the goodwill value totally. Then we need to go for the assets in the pro rata basis which are there in the CGUs. Okay. So I think these are the questions. Any other questions? Any other question, guys? I think no. You take it. Okay, guys. Thank you. You can reach out to me on this details. If you have any questions, you can reach out to me on these details. Either you can post on the taxico.com or on my mail IDs listed here, or there is my phone number, WhatsApp number. You can reach out to me on my phone number also if you have any other further requirements or questions on this regard. Thank you, guys. Thank you for participating in this. See you next time.